So the first risk facing the market that is top of mind for everyone in any asset class is Fed tightening and a potential interest rate shock. The Federal Reserve has ended their quantitative easing buying of mortgage-backed securities, and they're expected to raise interest rates next week, at least on the Fed funds rate, by most likely 25 basis points. Some Fed fund futures markets are anticipating up to 7 interest rate hikes this year, but I don't know how much weight I would put on some of those futures markets at this point. But regardless, it's important to take a look because obviously the cost of borrowing capital is significantly important. And to be able to really quantify this risk factor, we're looking to a research report that Berkadia put out a little over a month and a half ago, I believe, entitled Interest Rate, Stagflation, Inflation, and Monetary Policy, all related to multifamily. I thought it was I think it's a very kind of apt piece for the times. Some of the key takeaways is that changes in monetary policy appear to take 5 to 6 quarters to affect leveraged apartment returns. But surprisingly, real apartment returns outperform equities during times of quasi-stagflation, and we haven't really had real stagflation in a while, but real apartment returns still outperform the stock market. They're telling us to keep a close eye on the 10-year Treasury break-even inflation rates. And then average leverage apartment returns tend to remain stable even during high times of inflation, which makes a lot of sense because you're re-signing leases, one lease on a yearly basis. But if you have a large portfolio, and think about the Gray Fund, 7 to 10 assets, we're talking, easily, over 1,000 apartment units, you're re-signing new leases on a daily basis. And so we have the ability over the entire portfolio to track inflation on a daily basis. So higher inflation is actually very beneficial to a multifamily investment. And the multifamily has just historically proven time and time again to track inflation. Then the taper tantrum, because not only is the Fed raising interest rates, they're going to be unwinding their balance sheet. Looking back to 2013 at the last taper tantrum, multifamily was essentially unfazed. But let's actually look at some numbers. Average leverage apartment returns in an inflationary environment. You can see that really in the 1% to 4% inflation range, multifamily apartments perform very well. And they really start performing well, getting up to 7%. But the takeaway here is, inflation can cause a lot of uncertainty, but inflation means higher rents and continuing to drive returns. So while inflation can be scary from a macroeconomic standpoint, if you're allocated to apartments, you should really be able to sleep well at night. And if you're concerned about inflation, rising gas prices, multifamily is where you want to be. Now, this next graph looks at the relation to apartment yields and the 10-year Treasury. So that we're looking at, let's look at rising interest rates. There's really not a great correlation. Berkadia's conclusion is the relationship is not straightforward. You can see that returns go up kind of in this kind of between 0 and 2%, and they seem to decline over a period, and they go up when the rates are even higher. So it's less certain of, or there's less of a correlation, or a direct correlation at least, between leveraged apartment returns and just the 10-year Treasury or just interest rates in general. And a lot of that is because as interest rates rise, assuming that inflation is high and rents are also rising. So it's not just that interest rates go up and returns go down. That's obviously just not the case. This is again looking at the 10-year yield as well as, again, private apartment returns related to the 2013 taper tantrum. That's been a major concern. But if you really can see in this, I believe it's a blue line, there was really no effect from the taper tantrum. In fact, returns went up slightly. But there's no real correlation between taper tantrum or tightening of the balance sheet and apartment returns. Are really somewhat isolated. Now let's look at stagflation. Stagflation has been talked about more recently. Now, stagflation is essentially high inflation and low GDP growth. or high unemployment. And so they took a couple examples of environments since 1987 that were quasi stagflationary. Stagflation was coined in the 1970s. And what they found is that, while the Wilshire 5000, so, broad index of the stock market, had about a 3.8%, private apartment returns significantly outperformed, especially compared to higher growth asset classes such as technology companies that might be comprised in the NASDAQ. So we've quantified the risk, but what can we do to mitigate and adapt? Because just because we can say, all right, well, there's less correlation here, doesn't mean there aren't risks. There aren't things that we can do to really prevent the downside and try to maximize the upside. A couple things to do is, one, use fixed rate debt, or if you are using floating rate debt, certainly have a rate cap and stress test your models up to that rate cap and really assume that higher range of interest rates that you can have on your loan. Very important to watch organic growth, to really make sure your value add strategy makes sense. It may not make sense to spend a significant amount of capital, doing a certain renovation, maybe a cosmetic renovation, if there's already incredible amount of organic rent growth that you're already achieving, and especially if expenses are rising. And like in the environment we're in right now, where you can't get supplies, expenses are rising, you might just be able to take advantage of that organic growth. But at the same time, there may be times if that organic growth is slightly lower, you may need to conduct value add in forest appreciation more manually.